Before we dive in, a quick and important disclaimer. The information in this video is for educational and informational purposes only. I am not a licensed insurance agent or financial advisor. Your individual insurance needs are unique, and rates can vary dramatically based on your location, driving history, and dozens of other factors. Always consult with a qualified professional and read your policy documents carefully before making any decisions. This presentation is not sponsored by or affiliated with Geico or any of its parent or subsidiary companies. You see that little green gecko on TV. You hear the slogan 1,000 times. 15 minutes could save you 15% or more on car insurance. And you have to wonder, is it really that simple? Is Geico actually the cheapest option out there? And maybe the most important question of all, the one that keeps you up at night after you've signed on the dotted line. Will they actually be there for you when you need them most? When the worst happens on the road, will that friendly gecko have your back? Or will you be lost in a maze of call centers and legal jargon? This is the core anxiety every single American driver faces. Choosing car insurance feels like a high-stakes guessing game. You're trying to balance a monthly budget against a potential future catastrophe. You're bombarded with commercials from cavemen, quirky saleswomen, and former basketball stars, all promising the best deal. But when you get a quote, you're faced with a wall of confusing terms. Bodily injury liability, uninsured motorist coverage, comprehensive, collision, PIP, MedPay. It feels like you need a law degree just to understand what you're buying. And the fear is real. Pick the wrong coverage and a single accident could wipe out your savings, ruin your credit, and change your life forever. Pick the right coverage but with the wrong company, and you could be fighting for months just to get what you're owed. Well, that confusion ends today. This series is your definitive, no-nonsense guide to mastering Geico auto insurance in the United States. We are going to pull back the curtain and demystify the entire process, from getting an intelligent quote to understanding every line of your policy, to successfully filing a claim without losing your mind. By the end of this journey, you will have the confidence and the knowledge to build the perfect policy for your needs, and most importantly, to know if Geico is truly the right choice for you. We're not just going to talk about saving 15%, we're going to talk about being 100% protected. So, why are we focusing so intensely on Geico? Simple. They are an absolute titan of the industry. As of today, Geico is the third largest auto insurer in the entire country, right behind State Farm and Progressive. They provide coverage for over 28 million vehicles and have more than 17 million active policies. This isn't some niche company. They are a dominant force shaping the insurance landscape. Understanding how Geico works, their business model, their pricing strategy, their strengths and their weaknesses, is like having a master key to understanding the entire U.S. auto insurance market. The principles we uncover here will empower you to intelligently compare them against any other insurer you're considering. To truly understand Geico, you can't just look at their current commercials. You have to go back to the very beginning because their origin story explains everything about how they operate today. It all started in 1936, founded by a husband and wife team, Leo and Lillian Goodwin. And here's the first thing most people don't know. The name Geico is actually an acronym. It stands for Government Employees Insurance Company. That's right. Their initial brilliant business idea was to bypass the general public entirely and sell insurance directly to two specific groups they considered to be low risk: U.S. government employees and top-ranking, non-commissioned military officers. Think about that strategy for a moment. In the 1930s, these were some of the most stable and reliable customers you could find. They had secure jobs, steady incomes, and were statistically less likely to get into accidents. By cherry-picking the absolute best, lowest-risk drivers, Geico could afford to offer significantly lower premiums than their competitors who had to insure everyone else. But the real revolution wasn't just who they insured, it was how they insured them. While other insurance companies relied on a massive network of local agents who sold policies face-to-face, Geico pioneered a direct-to-consumer model. They sold their policies through the mail and later over the phone. This was a radical idea. It cut out the middleman, the local agent, and all the costs associated with them, the commissions, the office rent, the support staff. All of those savings were then passed directly on to the customer in the form of lower prices. This is the fundamental DNA of Geico that still exists today. That 15 minutes could save you 15% or more slogan isn't just marketing fluff. It's a direct promise rooted in their core business model. The entire company is built on the premise of massive scale and ruthless efficiency. They want you to go to their website or use their app, get a quote, and buy a policy with as little human interaction as possible. Every step you can complete yourself online is a step they don't have to pay a salaried employee to do. This direct model is their superpower. It's what allows them to process millions of policies and offer some of the most competitive rates in the nation. So what does this history lesson mean for you, the person looking for car insurance in the 21st century? It means you have to understand the fundamental trade-off you are making when you choose a company like Geico. The potential upside is clear: cost savings. By cutting out the traditional agent, you might very well get a fantastic price on your premium. For millions of Americans, especially those who are self-sufficient, tech-savvy, and comfortable managing their own accounts online, this is a perfect fit. You get great coverage for a great price, and you can manage it all from your smartphone. However, this model also has a potential downside, and it's a big one. The person you're sacrificing for those savings, the local agent, is also the person who would traditionally be your advocate, your guide, your expert advisor. When you have a complex question, you can't just walk into a local Geico office down the street, sit down across a desk, and have someone walk you through your policy. When you have a claim, you won't have a specific local agent who knows you and your history fighting on your behalf. Instead, you'll be interacting with a large, national call center or a digital claims process. For many, this is perfectly fine and efficient. But for those who value personal relationships and expert guidance, especially during the stress of an accident, this lack of a dedicated local agent can be a major drawback. This is the first and most crucial decision you have to make. Are you a do-it-yourself person who prioritizes price and digital convenience above all else? Or are you someone who wants a dedicated professional in your corner, even if it means paying a little more? There is no right or wrong answer, but understanding this core difference in business philosophy between Geico and more traditional insurers like State Farm or Allstate is the essential first step to making an informed choice. It's the foundation upon which your entire insurance experience will be built. Before we even look at a single coverage option or discount, you have to know what kind of company you're dealing with. Geico is a lean, mean, direct-to-consumer machine. It was designed that way from its very first day in 1936. And that structure dictates everything from the price you pay to the service you receive when you file a claim. So let's pull back the curtain on that design. To understand Geico, you can't just look at its talking gecko or its funny commercials. You have to go back to the Great Depression, to a man named Leo Goodwin. Goodwin wasn't an insurance mogul. He was an accountant working for another insurance company in Texas. And as an accountant, he saw something that everyone else was missing. He saw a massive inefficiency in the system. Back then, and for many companies still today, auto insurance was sold through agents. These agents were the middlemen. They'd find customers, sell them policies, and take a commission, a cut of the premium you paid. Goodwin looked at the numbers and realized that these commissions were a huge part of the cost of insurance, sometimes as much as 15 or 20%. On top of that, the company had to pay for the agent's office, their support staff, all of it. He thought, what if you could just get rid of the middleman? What if you could sell insurance directly to the customer and pass those savings on to them? It sounds simple now, in the age of the internet, but in 1936, this was a radical, almost crazy idea. But Goodwin's genius didn't stop there. He had a second, even more powerful insight. He realized that insurance is all about risk. The company takes your premium, puts it in a giant pool of money with everyone else's, and uses that pool to pay for accidents. The key to being a profitable insurance company is to make sure the money coming in from premiums is more than the money going out for claims. And how do you do that? You insure people who are less likely to get into accidents. You insure low-risk drivers. Goodwin looked at the general public and saw a huge mix of risk. You had reckless teenagers, traveling salesmen who were on the road 24/7, people with spotty driving records, all mixed in with careful, responsible drivers. The traditional insurance model just threw them all into the same general bucket and set a price. Goodwin decided to do the opposite. He decided to go hunting for the safest drivers in the entire country and only sell insurance to them. Who were these people? He identified two key groups: United States government employees and the top 3 grades of non-commissioned military officers. Think about it. In the 1930s, who were these people? They were stable. They had secure jobs during the Great Depression. They were generally older, more mature, and more financially responsible. They weren't joyriding on a Saturday night. They were statistically the safest, most predictable, most reliable drivers you could possibly find. So he put the two ideas together. 1. Sell directly to the customer, cutting out the agent's commission. 2. Sell only to a hand-picked group of ultra-low-risk drivers. This was the masterstroke. By targeting only the safest drivers, he knew his company would have fewer claims to pay out. And by selling directly, his operating costs would be dramatically lower. Fewer claims and lower costs meant he could offer prices that were so much cheaper than the competition, it was almost unbelievable. And that's exactly what he and his wife Lillian Goodwin did. They scraped together their savings, about $100,000, and in 1936, they founded the Government Employees Insurance Company, Geico. They didn't have a fancy headquarters. They worked from their kitchen table, mailing out flyers and making phone calls. It was the original direct-to-consumer, data-driven startup, decades before Silicon Valley even existed. This business model is the fundamental DNA of Geico. It is the reason the company exists and the core principle that guides it to this day. And its brilliance attracted the attention of another young man who, like Leo Goodwin, was obsessed with finding incredible businesses. His name was Warren Buffett. In the early 1950s, a young Buffett was a student at Columbia University, studying under the legendary investor Benjamin Graham. Graham happened to be the chairman of the board at Geico. One Saturday, Buffett, ever the curious student, took a train from New York down to Washington, D.C. and found his way to Geico's headquarters. The building was closed, but a custodian let him in, and eventually, he found the only executive working that day. For the next 4 hours, that executive explained the entire Geico business model to a fascinated Warren Buffett. Buffett was absolutely blown away. He immediately understood the power of what Leo Goodwin had created. He saw that Geico had what he would later call an economic moat, a massive, sustainable competitive advantage that other companies couldn't easily attack. The moat wasn't a secret formula or a patent. It was the structure itself. The combination of low costs from the direct model and low claims from selecting preferred customers was a fortress. Traditional insurance companies couldn't compete. To match Geico's prices, they would have to fire their entire army of agents, the very people who brought them all their business. It was impossible. They were locked into their high-cost structure. Geico, on the other hand, was built from the ground up to be lean and efficient. Buffett was so convinced that he put more than half of his personal net worth into Geico stock. Years later, his investment company, Berkshire Hathaway, would end up buying the entire company. So when you see a Geico ad today, you're not just seeing a commercial. You are seeing the modern-day execution of Leo Goodwin's 1936 vision, supercharged by the capital and philosophy of Warren Buffett. The company is still a direct-to-consumer machine. They don't have local agents you can sit down with in a fancy office, because paying for that office and that agent's salary would raise your premium. Instead, they pour that money into advertising billions of dollars a year to reach you directly through your TV, your radio, and your web browser. The gecko, the caveman, the 15 minutes could save you 15% or more. It's all the modern equivalent of Leo Goodwin's direct mail flyers. And the company is still obsessed with risk. While they no longer only insure government employees, their quoting process is a sophisticated evolution of that same principle. Every question they ask you, your age, your driving record, your zip code, your education level, your credit score, is designed to do one thing: figure out how risky you are. They are constantly crunching data to find those preferred risks. The modern-day equivalent of the stable government workers from the 1930s. This is the key to everything. Understanding this history isn't just a fun trivia fact. It explains the entire Geico experience. It explains why their prices can be so competitive. It explains why their business is primarily handled online or over the phone. And it explains who is most likely to get the very best rates. Geico is not trying to be the best insurance company for everyone. It's trying to be the lowest cost insurance company for a specific type of customer. The question we need to answer next is, are you that customer? Because the way you interact with their system, and the price it ultimately gives you, is a direct result of this nearly century-old business model. To find out if you're that customer, you have to understand that Geico isn't just selling a product. They are actively filtering. Their entire system, from the first ad you see to the final quote page, is a giant sophisticated machine designed to attract one type of person and frankly gently discourage another. Think of it like a nightclub with a very specific unwritten dress code. Some people walk right in, no questions asked. Others get stuck at the velvet rope, wondering why the price of admission is suddenly so high. So, who gets the VIP treatment? Let's call him low-risk Larry. Larry is Geico's dream customer. He's probably in his 30s, 40s, or 50s. He has a clean driving record, no at-fault accidents in the last 5 years, no speeding tickets, and definitely no DUIs. He drives a sensible car like a Honda Accord or a Toyota RAV4, not a souped-up sports car that screams risk. But the most important thing about Larry, the one thing that Geico's algorithms absolutely love, is his credit score. It's good. Probably very good. North of 720. Now you might be thinking, what on earth does my credit score have to do with my driving? And that is the multi-billion-dollar question. In the world of insurance, your credit score isn't just about how you handle debt. It's used to create something called an insurance score. Insurers have spent decades and fortunes on data that shows a powerful statistical correlation. People with higher credit scores tend to file fewer claims. It's not about whether you're a good or bad person. It's a cold, hard statistical prediction of future behavior. A person who pays their bills on time is, statistically speaking, more likely to perform regular maintenance on their car, less likely to drive recklessly, and less likely to file a small borderline claim. To Geico's algorithm, a high credit score signals stability and predictability. It signals a low-risk customer who will likely pay their premiums for years without costing the company much money. For low-risk Larry, the Geico experience is seamless. He goes to the website, enters his information, and the system instantly recognizes him as a prime candidate. The gears of the algorithm turn, see his clean record, his safe car, his excellent insurance score, and out pops a quote that is often incredibly competitive. It's low because Geico's entire business model, the one we talked about with no agents and low overhead, is built to pass those savings on to him. They are betting on him and millions of people like him to be profitable customers. Now let's meet another person. We'll call her Complex Casey. Casey isn't a bad driver, but her situation is, well, more complicated. Maybe she had one minor fender bender 2 years ago. Maybe she got a speeding ticket on a road trip last year. Or maybe she's younger, just starting her career, and her credit history is still a little thin, or she hit a rough patch financially that dinged her score. When Casey goes to the Geico website, the algorithm sees a different picture. Sees flags. That accident? That's a risk indicator. That ticket? Another one. That credit score below 650? That's a major one. The system can't see the context. It doesn't know that the accident wasn't really her fault, but was legally assigned 51% to her. It doesn't know the speeding ticket was for going 10 over on an empty highway. It just sees data points that deviate from the low-risk Larry profile. And so, the quote it generates for Casey is often significantly higher, sometimes shockingly so. This is where Geico's direct-to-consumer model becomes a double-edged sword. For Larry, the lack of an agent is a feature. It means savings. For Casey, it's a bug. She has no one to call to explain her situation. There's no local agent to build a relationship with, who can advocate on her behalf or look for unique discounts. She's left dealing with a website and a call center, and the price is simply the price the algorithm has decreed. This is the filtering process in action. The high price is a gentle market-based way of saying, we might not be the best fit for you. Geico isn't being malicious. It's just staying true to its business model of ensuring a very specific low-risk segment of the population at a massive scale. So the first, most crucial step in determining if Geico is right for you is to be brutally honest about which profile you more closely resemble. Do you have a spotless driving record going back at least 3, preferably 5 years? Is your credit score in good or excellent shape? If the answer to both of those questions is a resounding yes, you are in Geico's target demographic. You are the person their entire company was retooled to serve. But it goes deeper than just your record and credit. The ideal Geico customer also has a certain personality. They are a do-it-yourselfer. They are comfortable managing their accounts online. They don't mind using a mobile app to file a claim or get their insurance cards. They prefer the efficiency of a website over the small talk with a local agent. If you're the kind of person who wants to sit down with someone, have them review your entire financial situation, and build a long-term relationship, Geico's model is fundamentally at odds with your preferences. Their system is built for transactions, not relationships. It's clean, it's fast, and it's impersonal. For millions, that is exactly what they want. For others, it's a deal breaker. There are also a few specific groups that Geico has historically targeted with great success, and it pays to know if you're in one of them. The first, and most obvious, is government and military personnel. This is their origin story. The Government Employees Insurance Company. They offer special discounts and programs for active duty military, veterans, and federal employees. If you fall into this category, you absolutely must get a quote from Geico. It's often their most competitive bracket, a nod to their 85-year-old roots. The second group is students. Geico offers a good student discount that can be substantial. If you or your child is in high school or college and maintains a B average or better, That can shave a significant amount off your premium. For a young driver who would otherwise face astronomical rates, this can make Geico a surprisingly affordable option. Finally, there are the bundlers. Geico aggressively incentivizes customers who bring them more than just their car insurance. If you own a home, or even if you rent, bundling your auto insurance with a homeowner's or renter's policy can unlock their multi-policy discount. This is a key part of their strategy. A person who owns a home and has multiple policies is, once again, seen as stable, predictable, a low-risk Larry. They are less likely to switch insurers every 6 months, and more likely to be a profitable long-term customer. So if you're looking to insure more than just your car, Geico's pricing structure will likely reward you for it. So take a moment and look in the mirror. Are you a DIYer with a clean record, good credit, and maybe a home or military affiliation? If so, you're standing in the express lane and Geico is waving you through. But if your situation is more complex, with a few dings on your record or a desire for more personalized service, you might find yourself stuck at that velvet rope. But here's the critical thing to understand. Even if you fit the perfect profile, even if you are low-risk Larry personified and Geico offers you a price that seems too good to be true, that is only half the battle. The price is meaningless if the product itself doesn't protect you. Getting the wrong coverage can be infinitely more financially devastating than paying a slightly higher premium. And the 6 core types of coverage that Geico and every other insurer offers are a minefield for beginners, filled with jargon and confusing choices that can leave you dangerously exposed. So, now that we know who Geico is for, we need to understand what you are actually buying. Think of your Geico auto policy not as one single product but as a toolkit. You don't just buy a hammer. You buy a specific set of tools for the jobs you might face on the road. Some of these tools are legally required by the state. Others are just incredibly smart to have because the one time you need them, not having them can lead to financial ruin. Let's open up this toolkit and look at the 6 essential pieces that form the foundation of almost every auto policy in America. The first and most important part of your policy is called liability coverage. This is the big one. This is the component that is legally required in nearly every state. And here's the most critical thing to understand about it. Liability coverage is not for you. It never pays for your injuries or your car. It pays for the damage you do to other people and their property when an accident is your fault. It's your financial shield against lawsuits and crippling debt. Liability is broken down into 2 parts. First, there's bodily injury liability. Imagine you're running late, you glance at your phone for just a second, and you rear-end the car in front of you. The other driver gets whiplash and has to go to the hospital. Your bodily injury liability is what pays for their medical bills, their lost wages from being unable to work, and potentially even their pain and suffering. When you get a quote from Geico, you'll see this represented by 2 numbers like 25/50th. This isn't just random insurance jargon. That first number, 25, means your policy will pay up to $25,000 for one single person's injuries in an accident you cause. The second number, 50, is the total maximum your policy will pay for injuries for the entire accident, no matter how many people are hurt. So if you hit a minivan with 3 people in it, your insurance will pay out a maximum of $50,000 total, with no single person getting more than $25,000. Now here's the trap. Most people just buy the state minimum requirement to be legal, but a single night in the ER can cost more than $25,000. If you cause a serious accident and the other person's medical bills are $100,000, but your policy only covers $25,000, guess who's on the hook for the remaining $75,000? You are. They can sue you. They can garnish your wages for years. They can put a lien on your house. Choosing the state minimum is like bringing a water pistol to a wildfire. It's legally a firearm, but it's not going to save you. The second part of liability is property damage liability. This is the third number in that sequence, so you'll see it written as 25/50/25. That last 25 means your policy will pay up to $25,000 for damage you cause to other people's property. This is most often their car, but it could be anything. A fence, a mailbox, a storefront. Again, $25,000 sounds like a lot, but the average price of a new car in the US is now over $48,000. If you hit a brand new Ford F-150 or a Tesla, that $25,000 is gone in an instant, and you're paying the rest out of pocket. This is why skimping on liability limits is one of the single biggest financial mistakes a driver can make. Okay, so that's liability, it covers them. But what about you? The next tools in the kit are designed to protect you and your passengers. These are medical payments coverage, often called MedPay, and personal injury protection or PIP. They essentially do the same thing. They pay for your medical expenses after an accident, regardless of who was at fault. Think of it this way. After a crash, it can take weeks or months for the insurance companies to officially determine fault and decide who pays for what. But your hospital bills are due now. MedPay or PIP is your immediate financial first aid kit. It steps in right away to cover your health insurance deductible, co-pays, ambulance rides, or dental work, without waiting for the fault to be sorted out. If you have passengers in your car, it covers their initial medical bills too. The main difference is that PIP, which is required in what are called no-fault states, is much broader. It can also cover things like lost wages if you can't work, or even services you can no longer perform like childcare. MedPay is simpler and typically just covers direct medical bills. Choosing between them often depends on what state you live in and what your health insurance looks like, but having one of them is a smart buffer against immediate, crippling medical costs. Now for the third and arguably most underrated coverage, uninsured and underinsured motorist protection. Listen closely because this one could save you from an absolute nightmare. We've established that liability insurance covers the damage you do to others. But what happens when someone else hits you, and they have no insurance? Or they only have that bare-bones state minimum policy we talked about? The statistics are terrifying. The Insurance Research Council estimates that 1 in 8 drivers on the road is completely uninsured. That's about 30 million people driving illegally. If one of them plows into you and sends you to the hospital, their non-existent insurance policy isn't going to pay you a dime. You're left holding the bag for your own medical bills and your own car repairs. You could sue them, sure, but someone driving without insurance probably doesn't have assets to collect. It's a dead end. This is where uninsured motorist coverage becomes your hero. It steps in and acts like the insurance the other driver should have had. It pays for your medical bills and, depending on the state, can even cover your lost wages and car repairs. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their low-limit policy isn't enough to cover your bills. Your underinsured coverage pays the difference. Buying this coverage isn't about trusting other people. It's a bet on the unfortunate reality that many people on the road are irresponsible. It is insurance for your insurance. Finally, we get to the two coverages everyone thinks of when they imagine car insurance: collision and comprehensive. These are the two that actually pay to fix your car. Collision is straightforward. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it also covers you if you hit a stationary object, like a pole, a guardrail, or a tree. Pays out regardless of who is at fault. If someone runs a red light and T-bones you, collision pays. If you back into a pole in a parking garage, collision pays. Comprehensive coverage is the everything else policy. Think of it as the acts of God and bad luck coverage. It protects your car from damage not caused by a collision. This is the coverage that pays you if a tree branch falls on your car during a storm. It's what pays if your car is stolen. It covers damage from hail, fire, flooding, vandalism, or, and this is a big one, hitting an animal like a deer. Both collision and comprehensive come with a deductible. A deductible is simply the amount of money you have to pay out of pocket for a repair before Geico starts paying. For example, if you have a $500 deductible and you get into an accident that causes $3,000 of damage, you pay the first $500, and Geico pays the remaining $2,500. A higher deductible means a lower monthly premium, but it also means more out of your pocket when you file a claim. A lower deductible means you pay less after an accident, but your monthly bill will be higher. So there you have it. The 6 core building blocks of your Geico policy: bodily injury liability, property damage liability, MedPay or PIP, uninsured/underinsured motorist, collision, and comprehensive. These are the fundamental pieces that determine what is and isn't covered. But simply knowing what these tools are is only the first step. The real million-dollar question, the one that separates a useless policy from a financial fortress, is deciding how much of each coverage you actually need. Choosing the wrong limits can be just as devastating as having no insurance at all. And figuring out that perfect balance is exactly what we're going to break down next. So let's talk about those limits. Because this is where a cheap policy becomes the most expensive mistake of your life. Every state in the US has a legal requirement for the minimum amount of liability insurance you must carry. This is often called the state minimum. And I'm telling you right now, the state minimum is a trap. It's a financial landmine disguised as a good deal. Think of it this way: the state minimum is the government saying, This is the absolute lowest bar you can clear to be legally allowed on the road. It's not a recommendation. It's not a suggestion for what's safe or smart. It's just the legal floor. It's like the fire code saying you need one smoke detector in a mansion. Is it legal? Yes. Is it a good idea? Absolutely not. Relying on state minimum coverage is like showing up to a gunfight with a water pistol. You're technically armed, but you are not going to win. So what do these numbers even mean? When you look at a Geico quote, you'll see your liability coverage written as 3 numbers separated by slashes. For example, you might see something like 25/50/25. This is a very common state minimum limit. It looks like code, but it's actually simple. The first number is the maximum amount, in thousands of dollars, that Geico will pay for bodily injury to a single person in an accident you cause. So a 25 means $25,000. The second number is the maximum amount Geico will pay for bodily injury for all people combined in a single accident you cause. A 50 means $50,000 total, no matter if you injure 2 people or 5 people. The third number is the maximum amount Geico will pay for property damage in an accident you cause. This is for the other person's car or maybe that fence you hit or a light pole. A 25 here means $25,000. So 25/50/25. Let's put that into a real-world scenario. You're driving on the highway, you look down at your phone for just a second, and you slam into the back of a brand new Lexus. The driver of the Lexus gets a severe case of whiplash and a broken arm. The Lexus is totaled. Let's do the math. The medical bills for that one driver, ambulance, ER visit, surgery for the arm, physical therapy, could easily top $75,000. Your policy's limit for a single person? $25,000. That means Geico writes a check for $25,000, and you are personally on the hook for the remaining $50,000. But it gets worse. Let's say that Lexus was pushed into a Honda in front of it. Now the Honda driver also has injuries. Let's say their medical bills are a more modest $30,000. Your policy's limit for all injuries combined is $50,000. Geico paid $25,000 to the Lexus driver, so there's only $25,000 left. The Honda driver gets that, but they're still short $5,000. So now you owe $50,000 to the first driver and $5,000 to the second. You're $55,000 in the hole, and we haven't even talked about the cars yet. The brand new Lexus? It's worth $60,000. The Honda is worth $15,000. That's $75,000 in property damage. Your policy limit? A measly $25,000. Geico pays that, and you are now responsible for the other $50,000. So, in the span of 3 seconds, because you bought a state minimum policy to save a few bucks a month, you are now personally facing a lawsuit for $105,000. $105,000. That's not a bill you can just put on a credit card. That's the kind of debt that leads to your wages being garnished for years. They can put a lien on your house. They can seize your savings account. Your entire financial future, your ability to buy a home, save for retirement, or even just live without crushing debt is gone. All because of a policy that was good enough to be legal. So what are the right numbers? The boring but responsible answer is, it depends. But I'm going to give you a concrete, safe starting point that will protect the vast majority of people. For your liability coverage, you should start with limits of at least $100/300/100. Let's break that down. $100,000 for a single person's injuries, $300,000 for all injuries in an accident, and $100,000 for property damage. Why these numbers? $100,000 for a single person covers most serious but not catastrophic injuries. Keeps you out of court for the vast majority of accidents. $300,000 total gives you a huge cushion if you cause a multi-person accident. And $100,000 for property damage is crucial. Look around you on the road today. The average price of a new car is over $45,000. It is incredibly easy to total a $50,000 SUV, or cause a chain reaction involving 2 or 3 normal cars. That $25,000 limit is a joke in today's world. $100,000 is a realistic shield. Now, if you want to get more advanced, and you should, the best rule of thumb is to carry enough liability insurance to cover your net worth. Your net worth is the total value of everything you own, your savings, your investments, the equity in your home, minus your debts. If your net worth is $200,000, you should have at least that much in liability coverage. Why? Because that's what you stand to lose in a major lawsuit. You've worked hard for what you have. Your insurance should be strong enough to protect it. People who have nothing to lose can get away with state minimums. If you have a career savings, a home, you are a target. 100/300/100 is your starting point. Covering your net worth is your ultimate goal. Okay, that's liability. That protects you from hurting other people. But what about when someone else hits you? Specifically, what happens when you're hit by one of those people driving around with state minimum coverage? Or no insurance at all? It's estimated that 1 in 8 drivers in America is uninsured. 1 in 8. This is where uninsured and underinsured motorist coverage, often called UM/UIM, becomes your absolute best friend. This coverage steps in and pays for your injuries and your passengers' injuries when the person at fault either has no insurance or not enough to cover your bills. It's insurance against other people's irresponsibility. How much should you get? This one is simple. You should match your uninsured motorist limits to your bodily injury liability limits. If you have 100/300 in liability, you should have 100/300 in UM/UIM. You are essentially saying, I believe my own health and my family's health is worth just as much as a stranger's. It creates a perfect mirror of protection. Finally, there's a small but mighty coverage called medical payments or MedPay. In some states it's called personal injury protection or PIP, and the rules are a bit different, but the concept is similar. This is your immediate first aid kit. MedPay covers a set amount of medical expenses for you and your passengers, no matter who was at fault for the accident. There's no deductible. You get in a fender bender, your neck is sore, and you want to get it checked out? MedPay covers it. Your passenger breaks their wrist? MedPay covers the ER visit. It's designed to pay out quickly for those immediate costs, long before the lawyers and insurance companies have figured out who is officially at fault. It's relatively cheap, and having $5,000 or even $10,000 in MedPay coverage can be a lifesaver, preventing you from having to pay out of pocket for an ambulance ride or an X-ray while the bigger claims get sorted out. So let's recap the fortress we just built. We started with a strong foundation of liability coverage, 100/300/100 at a minimum. We mirrored that with uninsured/underinsured motorist coverage of 100/300 to protect us from others. And we added a $5,000 or $10,000 MedPay policy as our immediate response kit. This setup protects your assets, your savings, and your health from the vast majority of what can happen on the road. We've now built a financial shield to protect you from lawsuits and to cover your medical bills. But you might have noticed we haven't talked about one very important thing yet. Your car. What happens when your car is damaged or worse, totaled? How do you pay to fix it or replace it? That's where two of the most well-known and often most expensive types of coverage come into play. And understanding when you need them and when you don't is the key to not overpaying on your Geico policy. Let's talk about collision and comprehensive coverage. Think of them as the two guardians that protect the actual physical car you drive every day. While liability coverage is all about paying for damage you do to others, these two are about fixing your own vehicle. They are often bundled together and referred to as full coverage. But they are two very different things, protecting you from two very different kinds of chaos. Let's start with comprehensive. The easiest way to think about comprehensive coverage is this. It covers damage to your car from almost everything except a collision. It's the weird stuff coverage. It's the act of God coverage. Imagine you wake up one morning after a massive thunderstorm. You look out the window, coffee in hand, and your heart sinks. A huge limb from that old oak tree in your front yard has snapped off and crushed the roof of your brand new SUV. It looks like a crumpled soda can. Your liability coverage won't do a thing. You didn't hit anyone, but you're looking at $10,000 in damage. This is exactly what comprehensive coverage is for. It pays to repair or replace your vehicle if it's damaged by things like fire, theft, or vandalism. If a hailstorm turns your car's hood into a golf ball, that's comprehensive. If you're driving down a country road at dusk and a deer decides to redecorate your front grille, that's comprehensive. Flood damage? Comprehensive. A thief breaks your window and tries to steal your stereo? The broken window is covered by comprehensive. It's the protection against the unpredictable, the things that are completely out of your control. And just like with other coverages, it comes with a deductible. A deductible is simply the amount of money you agree to pay out of pocket before Geico's coverage kicks in. So if that tree branch caused $10,000 in damage and you have a $500 comprehensive deductible, you pay the body shop $500, and Geico pays the remaining $9,500. Now let's switch gears to its partner, collision coverage. This one is much more straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision. This is the coverage that kicks in when you back into a pole in a parking lot. It's for when you swerve to miss something and hit a guardrail. It's for when you're in an accident with another car, and it's determined to be your fault. Remember in the last part, we talked about how your property damage liability pays to fix the other person's car when you're at fault? Well, your collision coverage is what pays to fix your car in that same scenario. Without it, you'd be on your own to pay for your repairs, which could be thousands or even tens of thousands of dollars. It also covers you in a collision with another car, even if you're not at fault, which can be incredibly helpful if the other driver is uninsured or underinsured, a topic we'll dive into later. Just like comprehensive, collision coverage has its own deductible. You might choose a $500 deductible for collision and a different one, say $250 for comprehensive. They are separate. So if you hit a deer, a comprehensive claim, and then swerve into a ditch, a collision claim, in the same incident, you might actually have to pay both deductibles. It's rare, but it highlights how they are distinct pots of money for distinct types of damage. So, now for the million-dollar question, the one that directly impacts your wallet, do you actually need both of these? This is where a huge number of people overpay for their car insurance. The answer depends on one simple thing. Do you have a loan or a lease on your car? If the answer is yes, then the decision is already made for you. You need both. Period. Your lender, the bank or financial institution that gave you the loan, technically owns the car until you pay it off. It's their asset, and they are not going to risk you totaling a $30,000 car and then just walking away from the loan. They require you to carry both collision and comprehensive coverage to protect their investment. It's non-negotiable and will be part of your loan agreement. But what if you own your car outright? You've paid it off and the title is in your name. Now you have a choice. And this choice should be a cold, hard financial calculation. You need to ask yourself, what is my car worth and how much would it cost me to replace it? Here's a great rule of thumb many financial experts use, the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it. Let's break that down. Say you have a 12-year-old Honda Civic. It runs great, but it's got 150,000 miles on it. You look it up on a site like Kelley Blue Book, and its private party value is about $4,000. Now, you look at your Geico policy. You see that you're paying $50 a month, or $600 a year, specifically for the collision and comprehensive portion of your premium. Is $600 more than 10% of $4,000? Yes, 10% of $4,000 is $400. You're paying $600. According to this rule, it might be time to drop the coverage. Why? Because you also have to factor in your deductible. Let's say your collision deductible is $500. If you get into an accident and total the car, Geico will write you a check for the car's value, $4,000, minus your deductible. So you get a check for $3,500. But you've been paying $600 a year for that protection. In this scenario, you're paying a lot of money to protect a small asset. It might make more financial sense to drop the coverage, take that $600 you save each year, and put it into a separate savings account specifically for car repairs or a down payment on your next vehicle. Now let's flip it. Say you own a 3-year-old Toyota Highlander worth $30,000. The collision and comprehensive portion of your premium is, let's say, $800 a year. Is $800 more than 10% of $30,000? Not even close. 10% of $30,000 is $3,000. In this case, paying $800 a year to protect a $30,000 asset is an absolute no-brainer. You would be taking a massive financial risk by driving around without that coverage. This calculation is the single most effective way to make sure you're not insurance poor. As your car gets older and its value depreciates, you need to reevaluate your coverage every single year. And that brings us to the final piece of the puzzle for today. Choosing your deductible. Geico will offer you a range, typically from $250 all the way up to $2,000. The rule is simple. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. So which should you choose? The answer lies in your emergency fund. Ask yourself this question. If I had to write a check for my deductible amount right now, could I do it without breaking a sweat? If your deductible is $1,000, do you have $1,000 in a savings account that you can access immediately without it derailing your finances for the month? If the answer is no, you should probably opt for a lower deductible like $500. Yes, your premium will be a bit higher, but you're essentially prepaying for that peace of mind, knowing that a fender bender won't force you into credit card debt. If you have a healthy emergency fund, say 3 to 6 months of living expenses saved up, then you should absolutely raise your deductible. Moving from a $500 deductible to a $1,000 one can save you 15 to 30% on your collision and comprehensive costs. Over the years, that adds up to serious money. You're essentially self-insuring for that small initial amount, and you're letting Geico handle the catastrophic multi-thousand-dollar repairs, which is what insurance is really for. So we've covered protecting other people's property, and we've covered protecting your own car. But we've missed the most important asset of all. What about you? What about your passengers? What happens when you get hurt in an accident? Who pays for the ambulance, the hospital bills, the physical therapy, the lost wages from not being able to work? The answer to that is a whole different world of coverage, and in some states the most important parts aren't even optional. This is the world of first-party benefits, where your own Geico policy steps up to take care of you and your passengers, often without even asking who was at fault. We're talking about two key coverages: personal injury protection, or PIP, and medical payments coverage, also known as MedPay. In some states, one of these is mandatory. In others, it's an optional lifeline you'd be crazy to ignore. Let's start with the big one: personal injury protection. This is the cornerstone of what's known as a no-fault insurance system. About a dozen states in the US are considered no-fault states. And what that means is, if you get into an accident, your own car insurance company is the primary one to pay for your medical expenses, up to your policy limit regardless of who caused the accident. The entire point is to get you medical care and financial help fast, without waiting for lawyers and insurance companies to spend months arguing over who's to blame. So if you live in a state like Florida, Michigan, New York, or a handful of others, you don't just have the option to buy PIP coverage from Geico. It's required by law. But what does it actually do? This is where it gets incredibly powerful. PIP is not just health insurance for car accidents. So much more. Imagine you're in a crash. Your primary concern is your health. PIP coverage can pay for your ambulance ride, your emergency room visit, any surgeries you might need, and the follow-up physical therapy. But it doesn't stop there. What if your injuries are serious enough that you can't work for 3 weeks? A standard health insurance plan isn't going to help you with your lost paycheck, but PIP will. A major component of personal injury protection is reimbursement for lost wages. It can literally be the difference between staying afloat and facing financial disaster while you recover. And it goes even further. Let's say you're a stay-at-home parent. You don't have wages to lose, but if you break your arm in a car accident, you can't exactly take care of your kids, clean the house, or run errands. PIP can cover what are called essential services. It can help pay for things like childcare or a cleaning service while you're recovering. It's designed to help you maintain your normal life as much as possible after an accident disrupts it. In the most tragic circumstances, it can also provide a benefit to cover funeral expenses. So when you're looking at your Geico quote in a no-fault state, you won't see an option to remove PIP, but you will see options for your coverage limits. The state will mandate a minimum, say $10,000, but you can often buy much, much more. And this is a critical decision. A single night in a US hospital can cost more than that minimum coverage. Choosing a higher PIP limit is a direct investment in your own financial security. Now, what about the rest of the country? For those living in the other nearly 40 states, which are at-fault or tort states, the system is different. In these states, the person who caused the accident is responsible for paying for the injuries they caused, usually through their bodily injury liability coverage that we talked about earlier. But that can take time. An investigation has to happen. Fault has to be determined. The other driver's insurance company isn't just going to write you a check on the spot. So what do you do in the meantime? Your medical bills are arriving now. You need to see a doctor now. This is where medical payments coverage, or MedPay, comes in. MedPay is sort of like PIP's younger, more streamlined sibling. It is almost always an optional coverage you can add to your Geico policy, and it's typically very inexpensive. Like PIP, it's also no fault, meaning it pays out for your injuries regardless of who caused the crash. So how is it different? MedPay's focus is narrower and very specific. It covers necessary medical and funeral expenses for you and anyone in your car. It will pay for that ambulance ride, the ER visit, the doctor's copays, your dental work if you injured your teeth in the crash. It provides immediate cash for your immediate medical needs. What it doesn't cover are the things PIP does, like lost wages or the cost of hiring help for essential services. Think of it this way. MedPay pays the doctor, PIP pays the doctor and helps pay your rent while you can't work. At this point, a huge question probably pops into your head. Wait a minute. I have good health insurance. Why on earth would I pay extra for MedPay? This is one of the most common and most dangerous misconceptions in car insurance. Relying solely on your health insurance after a car accident is a massive gamble. And here's why. First, deductibles and copays. What's your health insurance deductible? $1,000? $5,000? $10,000? After an accident, you'd have to pay that entire amount out of your own pocket before your health insurance pays a single dime. MedPay coverage can pay for those initial bills and cover your deductible for you. You can literally use your car insurance to pay for your health insurance deductible. Second, and this is the big one, your passengers. Your health insurance covers you and only you. What about the 3 friends you were driving to lunch? If you get into an accident, your health plan does absolutely nothing for them. But MedPay covers every single person in your vehicle. It's an incredible act of responsibility and kindness. You're ensuring that your friends or family members don't get stuck with a surprise medical bill just for riding in your car. Third, some things just aren't covered well by health insurance. Ambulance rides are a classic example. Many health plans have surprisingly limited coverage for them. Same goes for things like dental work or chiropractic care that might be needed after a crash. MedPay often fills these gaps beautifully. And finally, MedPay has no network restrictions. An accident can happen anywhere, and you might get taken to the nearest hospital, not one that's in your health insurance network. That can lead to astronomical out-of-network bills. MedPay doesn't care about networks. It pays for reasonable and necessary medical care, period. So when you're on the Geico website getting your quote, and you see that option for MedPay, don't just dismiss it. For the price of a few cups of coffee a month, you're buying peace of mind. You're buying immediate access to medical care without worrying about your deductible. And you're protecting every single person who ever sets foot in your car. Choosing your limits for MedPay is usually straightforward. You'll see options like $1,000, $5,000, or $10,000. A good rule of thumb is to select a limit that is at least as high as your health insurance deductible. That way, you know you're covered for those initial out-of-pocket costs. So, let's recap this crucial piece of the puzzle. You have liability coverage to pay for damage you cause to others. You have collision and comprehensive to fix your own car. And now with PIP or MedPay, you have a shield to protect your own health and finances, paying for your medical bills and, in the case of PIP, even your lost wages no matter who was at fault. You've built a fortress of financial protection around yourself, your passengers, and your vehicle. Seems like every angle is covered. You're a responsible driver with a great Geico policy. But there's a ghost in this machine. A variable you have absolutely no control over: the other driver. What happens when the person who slams into you at a red light gives the police officer an expired insurance card? What happens when they have no insurance at all? Or what if they did the absolute minimum, buying a policy with just $15,000 of liability coverage, but your medical bills from the crash are over $100,000? Suddenly, their lack of responsibility has become your catastrophic problem. You're the victim, but you're the one left holding a bill that could bankrupt you. How do you possibly protect yourself from that? The answer is a specific type of coverage that acts as a shield, not for others but for you. It's called uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. And frankly, it might just be the most important coverage you've never heard of. Let's break that down because those are two different scenarios. First, you have uninsured motorist coverage. This is for the absolute worst-case scenario. You're hit by a driver who has zero insurance. They're driving illegally and they cause you harm. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. In some states, it's as high as 1 in 4. Think about that. On your daily commute, you will likely pass dozens, if not hundreds, of drivers who have no way to pay for the damage they might cause you. They are financial time bombs on wheels. If one of them hits you and you get hurt, your uninsured motorist bodily injury coverage, or UMBI, steps in. It acts as if it's the insurance the other driver should have had. It pays for your medical bills, your lost wages if you can't work, and even pain and suffering, up to the limits you select on your Geico policy. Without it, you'd be forced to sue the uninsured driver personally, a person who likely couldn't afford insurance in the first place, meaning they almost certainly have no assets to pay you with. You can't get blood from a stone. UMBI protects you from their total irresponsibility. Now let's talk about the second and arguably more common scenario. This brings us back to that terrifying cliffhanger. This is underinsured motorist coverage, or UIM. This is for the driver who did the bare minimum. They bought the cheapest state-required liability policy and called it a day. They have insurance, but it's nowhere near enough. Let's replay that accident. The other driver runs a red light and T-bones you. The crash is severe. You're hospitalized, you need surgery on your leg, and you'll require months of physical therapy. Your total medical bills come to $125,000. The other driver, who was 100% at fault, has a bodily injury liability limit of just $25,000. That's the state minimum in many places. Their insurance company cuts you a check for $25,000. That's it. That's all they are legally required to pay. You are still facing a $100,000 mountain of medical debt. $100,000 that you have to pay because someone else was reckless. This is where your own Geico policy, armed with underinsured motorist coverage, becomes your hero. Your UIM coverage kicks in to pay the difference. If you had selected a UIM limit of $100,000, Geico would pay that remaining bill. If you had selected a limit of $250,000, it would cover the $100,000 with ease. Your UIM coverage bridges the gap between the other driver's pathetic policy and your actual costs. It prevents you from being financially ruined by someone else's decision to be underinsured. Let's make this real. Imagine a nurse named Sarah. She works 12-hour shifts, she's saving for a house, and she's diligent about her finances. One evening, driving home exhausted, a college kid texting and driving blows through a stop sign and plows into her driver's side door. Sarah suffers a broken hip and a concussion. Her car is totaled. The kid is at fault, but he's driving on his parents' policy with the lowest possible limits, $25,000. Sarah's surgery, hospital stay, and the ensuing months of physical therapy cost over $150,000. She's out of work for 4 months, losing over $20,000 in wages. The total financial damage is approaching $175,000. The kid's insurance pays its $25,000 max, and it's gone in an instant. It barely covers the initial emergency room visit. Now Sarah is staring at a $150,000 hole in her life. Her dreams of a house are gone. Her savings are vaporized. She's facing bankruptcy, all because of a moment of carelessness from another driver. But when Sarah set up her Geico policy, she listened to some good advice. She had added underinsured motorist coverage with limits of $250,000. She makes one phone call. She explains the situation, and her own insurance company steps up to defend her. Geico covers the remaining $150,000 in medical bills and lost wages. Her financial life is saved. She can focus on healing, not on fighting with bill collectors. That is the power of UIM coverage. So how much should you get? Here is the simplest, most powerful rule of thumb you will ever hear about car insurance. Your uninsured and underinsured motorist coverage limits should match your own bodily injury liability limits. Think about it. In the last part, we discussed how bodily injury liability protects your assets if you hurt someone else. You might have chosen limits of $100,000 per person and $300,000 per accident. You decided that you are worth protecting up to that amount. So why on earth would you give yourself less protection than you give to a total stranger? If you believe your financial life is worth protecting with $100,000 in liability, then you must believe your own health and well-being are worth protecting with $100,000 in UM/UIM coverage. You are insuring yourself against the vast number of irresponsible drivers on the road. And the best part? It is often one of the least expensive coverages to add. For a few extra dollars a month, you are buying hundreds of thousands of dollars in peace of mind. Now, Geico, like all insurers, has to follow state laws, and this is where it gets a little more complex. In some states, UM/UIM coverage is mandatory. In others, it's optional, but insurers are required to offer it to you. In a few states, the rules are different. This is why it is absolutely critical you look at your Geico policy declaration page or your online quote and find this line item. Don't assume you have it. Verify it. And here's a pro tip that can make a monumental difference, something most people have no idea even exists. In many states, Geico offers the option of stacked versus unstacked UM/UIM coverage. Unstacked is the default. If you have a $100,000 limit, that's the most you can claim, period. But stacked coverage is a game changer for anyone with more than one car on their policy. Stacking allows you to combine the UM/UIM coverage limits for each vehicle you insure. Let's say you have 2 cars on your Geico policy, and you have $100,000 of UM/UIM coverage on each. If you are hit by an uninsured driver while in either of those cars, or even as a pedestrian, you can stack those limits. Your $100,000 of coverage instantly becomes $200,000 of coverage. If you have 3 cars, it becomes $300,000. It multiplies your protection. It costs a little more than unstacked coverage, but it provides an incredible safety net, especially for families. If your state allows it, stacking your UM/UIM coverage is one of the smartest insurance decisions you can make. Finally, there's a small piece of this puzzle called uninsured motorist property damage, or UMPD. This is designed to repair your car if an uninsured driver hits you and you don't have collision coverage, which we'll discuss next. If you do have collision, UMPD can still be useful because the deductible is often much lower. For instance, your UMPD deductible might be $250, while your collision deductible is $1,000. It would save you $750 in out-of-pocket costs. So let's recap the fortress you've just built. With bodily injury and property damage liability, you're protected from financially ruining someone else and facing a lawsuit. With uninsured and underinsured motorist coverage, you're protected from being financially ruined by someone else. You've covered the two biggest risks involving other people. But we've ignored a huge piece of the puzzle. What about your car? Your $10,000, $20,000, or $50,000 asset sitting in the driveway? What happens if you're the one who makes a mistake and hits a pole? What happens if a tree branch falls and shatters your windshield during a storm? What if your car is stolen? Or you hit a deer on a dark country road? In all of those cases, none of the coverages we've discussed will pay a single penny to fix or replace your vehicle. So how do you protect the actual car itself? That's where the two most common, and yet most misunderstood, coverages in any auto policy come into play. And getting them right can save you thousands. These two critical protections are called collision and comprehensive coverage. Let's break them down right now because understanding the difference isn't just trivia. It's the key to not getting financially wiped out by one bad day. Think of it like this: collision coverage is for when your car, well, collides with something. It's the bodyguard for your car when you're in motion and make a mistake. You back into a pole in a parking garage? Collision. You swerve to miss a squirrel and hit a guardrail? Collision. You're in an accident that's deemed your fault, and your front end is crumpled? That's what collision coverage is for. It pays to repair or replace your own vehicle, regardless of who was at fault. This is huge because if you cause an accident, the other person's liability insurance isn't going to give you a dime for your car. Your own collision coverage is your only safety net. Now, let's talk about comprehensive. This is the one people get wrong all the time. The name is a little misleading. It doesn't mean it comprehensively covers everything. A better name would be almost everything else that's not a collision coverage. This is your car's bodyguard against the chaos of the world. Think of it as act of God and act of jerk insurance. A deer jumps out of the woods at dusk and you hit it? That's not a collision in insurance terms. That's a comprehensive claim. A massive hailstorm rolls through and your car looks like a golf ball? Comprehensive. A branch from your neighbor's ancient oak tree snaps off in a windstorm and crushes your roof? Comprehensive. Your car gets stolen from your driveway? Comprehensive. Someone keys your car out of spite or smashes a window to steal your gym bag. That's vandalism, and you guessed it, it's a comprehensive claim. So, to put it simply, collision is for when your car hits an object. Comprehensive is for when an object, or an event, hits your car. Now, here's the most important part of this whole discussion, the part where you take control of your policy and your budget. Both collision and comprehensive coverage come with a deductible. A deductible is simply the amount of money you agree to pay out of pocket for a repair before Geico's coverage kicks in. You are sharing the risk with the insurance company. Let's say you have a $500 deductible. You get into a fender bender, and the repair estimate is $3,000. You pay the first $500 directly to the body shop. Geico then pays the remaining $2,500. If the damage was only $400, you just pay it yourself because it's less than your deductible. You wouldn't even file a claim. This is where you have a massive amount of power. Geico, like all insurers, lets you choose your deductible amount. Common options are $250, $500, $1,000, or even $2,000. And here is the golden rule. The higher your deductible, the lower your monthly premium will be. Think about it from Geico's perspective. If you choose a high deductible, say $1,000, you're telling them, I'm willing to handle the small stuff myself. Don't bother me unless it's a really big problem. This makes you a lower risk to them, so they reward you with a lower price. If you choose a low deductible like $250, you're saying, I want you to cover almost everything. This makes you a higher risk, so your premium will be higher. So which one should you choose? This isn't an insurance question. It's a personal finance question. The only right answer is based on your own situation. You have to ask yourself one brutally honest question. If I got into an accident tomorrow, how much cash could I comfortably write a check for without breaking a sweat? If that number is $1,000, then choosing $1,000 deductible might be a fantastic way to save a significant amount of money on your premium every single year. But if you're living paycheck to paycheck and a surprise $500 bill would send you into a panic, then you absolutely should not choose a $500 deductible just to save $12 a month. You'd be better off paying a little more for the premium in exchange for the peace of mind that comes with a lower, more manageable $250 deductible. This single choice, matching your deductible to your emergency fund, is one of the smartest financial moves you can make. Now, this brings up the next big question: does everyone actually need collision and comprehensive? The answer is a hard no. And this is where you can potentially save a fortune. First, if you have a loan or a lease on your car, the decision is made for you. Your lender, the bank that technically owns the car, will almost certainly require you to carry both collision and comprehensive. They have a financial interest in that vehicle, and they need to make sure their asset is protected until you pay it off. For you, it's not optional. But what if you own your car outright? What if it's paid off? This is where you need to do some simple math. These coverages pay out based on something called the actual cash value, or ACV, of your vehicle. That's a fancy term for what your car is worth right before the accident, taking into account its age, mileage, and condition. It is not what you paid for it or what a new one would cost. Let's imagine you're driving a 12-year-old sedan that you love, but its actual cash value is only about $3,000. Now look at your Geico policy. How much are you paying per year specifically for collision and comprehensive coverage? Let's say it's $600 a year. You are paying $600 to protect a $3,000 asset. If you totaled the car tomorrow, Geico would write you a check for $3,000 minus your deductible, so you might get $2,500 back. Is paying $600 a year for a potential $2,500 payout worth it to you? Maybe, but maybe not. A good rule of thumb many financial experts use is the 10% rule. If the annual cost of your collision and comprehensive premium is more than 10% of your car's value, it might be time to seriously consider dropping them. In our example, 10% of the car's value is $300. You're paying $600. According to this rule, you could be better off dropping the coverage, taking that $600 a year you were paying to Geico, and putting it into your own dedicated car repair or replacement savings account. You become your own insurance company for your car's physical body. This is a personal choice. It's about risk tolerance. But for millions of Americans with older, paid-off cars, continuing to pay for this coverage is like buying expensive flood insurance for a house on a hill. It's a waste of money that could be better used elsewhere. So, we've now built the core of a powerful auto insurance policy. We've protected your assets from lawsuits with liability coverage. We've protected your own body from uninsured drivers with UM and UIM. And now we've protected the value of your car itself with collision and comprehensive. You're 90% of the way to a rock-solid policy. But what about the little things? The things that don't cost thousands, but can completely ruin your day. What happens when your battery dies in the middle of nowhere? What happens if you get into an accident and your car is in the shop for 2 weeks? How do you get to work? These small inconveniences can quickly become major, expensive headaches. And that's where the final crucial pieces of the puzzle come in. The small, surprisingly cheap add-ons that can be absolute lifesavers. Let's start with the most common one: rental reimbursement. This is exactly what it sounds like. If your car is in the shop for a covered repair, meaning something your collision or comprehensive policy is paying for, this coverage helps pay for a rental car. And the cost for this add-on is, frankly, almost laughably low. We're often talking about the price of a single cup of coffee per month, but think about the alternative. The average repair time after a significant accident can easily be a week, 2 weeks, sometimes longer if parts are on backorder. Let's do the math. A basic rental car might cost you $50 or $60 a day. Over 10 days, that's $500 or $600 out of your pocket, just to maintain your ability to get to work, pick up your kids, and live your life. For a few extra dollars on your premium, Geico will cover a certain amount per day, up to a certain total amount for that rental. When you're getting your quote, you'll see options like $30 a day up to a $900 maximum, or $50 a day up to a $1,500 maximum. For most people with only one vehicle, this isn't a luxury. It's a necessity. It transforms a major, stressful expense into a simple, manageable inconvenience. You just saved yourself hundreds of dollars and a massive headache for pennies on the dollar. Next up is another absolute must-have for many people: emergency road service or roadside assistance. Picture this. It's late at night. You're driving home on a road you don't know very well, and suddenly you hear that awful rhythmic thump thump thump. You've got a flat tire. Or maybe it's worse. Your engine sputters and dies, and you coast to a stop on the shoulder, miles from the nearest town. What do? You could start Googling for a local tow truck company, hoping you find a reputable one, and then prepare to pay anywhere from $100 to several $100s for a single tow depending on the distance. Or you could have roadside assistance. For, again, an incredibly small monthly cost, you get a 24/7 lifeline. With Geico, it's all integrated into their mobile app. You open the app, tap a button, and it uses your phone's GPS to pinpoint your exact location. You tell it the problem: flat tire, dead battery, ran out of gas, locked your keys in the car, and they dispatch someone to you. This covers the service call. It covers the labor to change your tire with your spare. It covers a jump start. It covers towing to the nearest repair facility. It turns a potential crisis, a moment of real fear and vulnerability, into a simple phone call and a bit of a wait. The peace of mind alone is worth the minuscule cost, especially if you're not mechanically inclined or if you frequently drive alone or in unfamiliar areas. Now for a slightly more specialized, but powerful Geico offering: mechanical breakdown insurance, or MBI. This one is often confused with an extended warranty you might buy from a dealership, but it's different and in many ways better. MBI is something you can add to your policy, but there's a catch. It's generally only for new or relatively new cars, typically less than 15 months old, and with fewer than 15,000 miles. But if your car qualifies, it's an incredible value. Think of it like health insurance for your car's most vital and expensive parts. It covers repairs to all major mechanical and electrical systems: the engine, the transmission, the drive axle, the air conditioning, the steering, basically, all the things that can cost thousands of dollars to fix if they fail. It doesn't cover routine maintenance like oil changes or wear and tear items like tires and brakes. This is for the big, unexpected, catastrophic failures. You pay a flat, low deductible, usually around $250, and Geico covers the rest of the bill for that covered repair. And you can keep this coverage for up to 7 years or 100,000 miles. Compare that to a dealership's extended warranty, which can cost thousands of dollars up front. MBI is a small, manageable addition to your premium. If you're buying a new car and plan to keep it past the manufacturer's warranty period, Geico's MBI is one of the most cost-effective ways to protect yourself from enormous, budget-destroying repair bills down the road. So let's take a step back and look at the entire picture we've built over this series. We've constructed your perfect auto insurance policy from the ground up. We started with the foundation: liability coverage. That's your shield, protecting your assets from the costs of an accident you cause. It's the one part of insurance that isn't for you. It's for everyone else on the road, and it's required by law. Then we built the walls of your fortress with collision and comprehensive coverage. This is the part that's for you. It's what pays to repair or replace your own car. Whether you hit a tree, get hit by a falling branch, or have it stolen. We learned how your deductible is your share of the risk, and how adjusting it is the single most powerful lever you have to control your premium. We then reinforced those walls with uninsured and underinsured motorist coverage, the critical protection against the millions of drivers who are either breaking the law with no insurance or carrying the bare minimum that won't even begin to cover a serious injury. We added medical payments or personal injury protection to ensure your own medical bills get paid quickly, regardless of who is at fault. And just now, we've furnished our fortress with the essentials that make life livable after a disaster: rental reimbursement to keep you on the road, and roadside assistance to be your guardian angel when you're stranded. You are now armed with the knowledge to make an intelligent, informed decision. The final step isn't to just blindly buy a policy. The final step is to take control. Go to the Geico website or open the app. Start the quote process not as a chore, but as an experiment. Plug in your information and get your baseline quote. But don't stop there. This is where your new knowledge becomes power. Slide that collision deductible from $500 to $1,000. Watch what happens to your 6-month premium. Does the savings justify the extra risk you're taking on? For your car and your budget, maybe it does. Now slide it back. Go to your liability limits. See the price difference between a 50/100/50 policy and a 100/300/100 policy. You might be shocked at how little it costs to double or triple your financial protection. Add rental reimbursement. See that number barely budge? This is no longer a confusing form. It's your personal risk management dashboard. You are now the pilot, not just the passenger. You are consciously deciding how much risk you're willing to accept and how much you want to transfer to the insurance company. Look for the discounts. Are you a good student? A member of the military? Do you have an anti-theft device? Every box you check is you actively lowering your own rate. When you're done, you won't just have a price. You will have a policy that is custom-built for your life, your car, and your personal comfort level with risk. You'll understand why it costs what it costs, and you'll have the confidence that you are not paying for things you don't need, and that you are covered for the things you do. We started this journey because auto insurance is one of those things everyone needs but so few truly understand. It's a language of its own, filled with jargon designed to be confusing. But now you speak the language. You know what bodily injury liability really means for your life savings. You understand the fundamental difference between collision and comprehensive. You know that the cheapest policy is almost never the best policy. You have gone from being a passive buyer to an educated consumer. You've invested this time to protect your financial future, and that knowledge is something no one can ever take away from you. The 15 minutes you might save on a quote is nothing compared to the financial security you can now build for a lifetime. Take this knowledge, take this confidence, and build the policy that's right for you.